Welcome back. In this video, we're going to go through the periodic inventory system, and we're going to look at the same example we use with the perpetual inventory system and kind of look at which transactions changed and talk through those changes. We should remember that with the periodic inventory system, inventory is not adjusted after every transaction. Why? Because in this system, they don't keep very good or very complete and accurate day-to-day records of inventory. Inventory is just on the shelves or being used, being sold, being bought, but the sales are not coming off of the books as the inventory is sold. Therefore, that has to be accounted for at a later date. And that's why they call it periodic, because it is accounted for at a different point in time at a certain period of time. And so the inventory system of periodic, we're going to go through using the exact same example we have. I left the answers from the perpetual system there, and we're just going to make some adjustments based on what would happen with the periodic system versus the perpetual system. And so just keep your eyes on these journal entries because they are about to change. April 2nd, let's start with that. Inventory purchased from Walmart to be sold by T&T School Supplies. 100 textbooks were purchased that cost $25 each. Under the perpetual system, we debited merchandise inventory and credited cash. Now, the only thing that changes here, and in most of these instances, is going to be the name of the account that we're going to use. Underneath the periodic system, they don't have an account called merchandise inventory, but in fact, the account's name, I want to highlight it, the account's name, let's highlight that color. The account name is called purchases. So there is no merchandise inventory underneath the periodic method. There's just an account called purchases, and that account stores the value of all of the inventory assets that we purchase. Purchases is an asset account, just like merchandise inventory. So the same way merchandise inventory is affected, purchases account is also affected. And that's really the only difference that happens in the first transaction, because the value doesn't change or anything. What mostly changes, or what changes in most of these transactions, will be the account name. But that's about it. So that's the first one. The second one, 7. The Anglican school came into the store and purchased 30 books for $50 each on credit. Now, this account is the account where or this transaction is where we have the 4 accounts. 2 of these record the effect of the sale, and 2 of them record the effect of the inventory. The ones that record the effect of the sale are accounts receivable and textbook revenue, because those are the only ones that take into consideration the sale price. These other 2 accounts, cost of goods sold and merchandise inventory, do not take into consideration the sale, but they take into consideration the inventory. As we said, with periodic, inventory doesn't matter. And so therefore, that means that this account now is null and void. It's not necessary anymore. And so as a result of that, we can actually block this out because we don't need it. We don't need a cost of goods sold underneath the periodic system. We don't need merchandise inventory. As a matter of fact, merchandise inventory doesn't exist underneath the periodic system. And so these transactions here are no longer necessary and no longer valid. And that's it. All that's required is the same 2 accounts here. Accounts receivable, $1,500. Textbook revenue, $1,500 being credited. None of them change because these are the same type of accounts under both systems. Accounts receivable is common among any business. That's a standard account for every business that sells items on credit, items or services on credit. Textbook revenue remains the same because we're still dealing with the same company, and the name of the account doesn't change because they are still selling textbooks, and it still is revenue. And that is the transaction for the 7th. The transaction on the 8th, now, a customer walked in and purchased one textbook for $50. Essentially is doing the exact same thing, except that we didn't have an accounts receivable affected because we sold it with cash. And so cash replaces accounts receivable and textbook revenue remains the same. Again, cost of goods sold is not necessary underneath the periodic method. Neither is that $25 that we're accounting for. Merchandise inventory, the exact same thing. Underneath this method, that doesn't even exist. And so we take those out, and the only transactions that should have been recorded on the periodic is cash, $50, textbook revenue, $50. Okay, and that's pretty much it for the 8th. Now, on the 12th, it says the Anglican school returned and brought back 10 books that were damaged. You agree to give them a credit. Similar to how we did the reverse of the selling of the inventory item, the same happens when a customer returns an item. We just do the reverse again. So, the reverse of that would be textbook revenue and accounts receivable. Merchandise inventory, out, doesn't exist. And cost of goods sold, out, doesn't exist. What's left is sales return and allowances and accounts receivable. Now, underneath the periodic method, this is still correct. There's nothing left to change underneath this method. And so that is what it is. That's the end of that. That transaction is complete. If we move on to the 20th, it said the Anglican school sent a check in the amount of $1,000 on their account. This doesn't involve inventory at all, so there's absolutely no change that happens here underneath the periodic method. On the 21st, it says the company returned the 10 damaged goods and received a refund. So this is an inventory transaction. And so let's look at what's different. What would be different? Cash wouldn't be different because no matter which system is being used, they still receive $250 cash in exchange for the damaged books. Only difference would happen is the name of this account. As we should know, I've said it multiple times already, merchandise inventory is not an account under the perpetual system. And so therefore what happens is we just have to make a change to the name of this account because that's the only thing that really needs to change here. And the name that we would use would not be purchases, but purchases, returns, and allowances. That would now be the name that we use because that's where they're keeping a record of all of the purchases returns that were received or that were made for later data as to when they go back and revise and we look at the inventory. Okay, you'll notice that, like I say, with this, we don't record cost of goods sold, we don't record changes in inventory. None of that is done right now. It's done, but it's just done later. It's usually done at the end of the month or at the end of the year, depending on what it is. But most times it's the end of the month. And it's done just to make sure that the income statement is correct, because without having any cost of goods sold but you have sales, that doesn't make sense. As long as you have sales, there's a cost for what you sold. And so what happens is periodically they just calculate the cost of goods sold and they post that directly to that account as a different entry. But we're not getting into that entry right now. So we're just trying to understand the difference between the two methods, the two systems. And that's pretty much it. I took out everything that I blocked out, and so you'll see that my stuff or my journal entries remain balanced at 5,800 on the debit, 5,800 on the credit. And so, yeah, I'm looking good. I'm looking real good. And I'll highlight this here the same way I did the first one, with the only account names that change, purchases, and purchases, return, and allowances. Everything else remains the same, just excluding any adjustments for merchandise inventory and cost of goods sold. And so I hope this video helps and gives some type of clarity on the two methods.